If you've rented a place in this country any time over the last 10 years, you already know the exact sound of that door. That flat, hollow thud when it swings shut behind you. You know the smell of the damp patch in the corner your landlord promised to sort 3 winters ago. You know the radiator that rattles like a bag of nails when the heating clicks on at 6 in the morning. You know that quiet, creeping dread every time a letter from the letting agency slides through your letterbox. Now picture a different room entirely. 200 miles north, in a quiet kitchen in a leafy Manchester suburb. No damp here. The radiators actually work. But there's a different kind of tension in the air. The soft click of a mouse at 10 o'clock at night. An older couple scrolling through a map covered in little red sold pins in areas they've never lived themselves, working out numbers on a calculator between them. This is the headquarters of Britain's biggest, most unregulated, entirely unintentional financial institution. No glass tower in the city, no app, no logo. But without it, the entire British housing market would grind to a stop almost overnight. Welcome to the Bank of Mum and Dad. I spend way too much time thinking about how a bank with no building, no app, and no logo somehow became the thing quietly propping up the entire British property market. If you're someone who's ever had to ask your parents for help buying a home, or wondered whether you'll ever get the chance to ask, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. We used to talk about the Bank of Mum and Dad like a bit of a quirky middle-class habit, a little leg up for the lucky few, a few grand toward the solicitor's fees, maybe enough to get someone over the line on a flat in the suburbs. Not anymore. Research from Savills puts family gifts and loans to first-time buyers at £8.3 billion in a single year. Fold in inheritance being pulled forward early to help with a purchase, and the number climbs past 11 billion. If the Bank of Mum and Dad were an actual high street lender, it would sit comfortably among the biggest mortgage providers in the country. So how much are parents actually handing over right now? Who's getting it? And what happens to the roughly half the country who can't knock on their parents' door for a 5-figure cheque? Let's look at the actual maths of buying a home in Britain today. The old rule of thumb was simple. Get a steady job, live within your means, put a bit away every month, and by your late 20s you've got a deposit. That story's basically dead. Research comparing buyers who get family help with those who don't makes the gap clear. First-time buyers with family support put down an average deposit of around £118,000. Buyers without that help put down closer to £60,000. For a lot of people, family money isn't just topping up a deposit anymore, it's very nearly doubling it. And that's not some small minority leaning on their parents. Savills puts the overall figure at 53%. More than half of all first-time buyers now get some kind of financial help from family, whether that's a gift, a loan, or an early inheritance. Among the youngest buyers, those between 20 and 24, that figure climbs to 63%. For most people that age, buying without family behind them genuinely isn't an option. And it isn't just 20-somethings fresh out of university asking for help either. Buyers who receive family support tend to complete their purchases around age 30. Those going it entirely alone are typically a couple of years older, in their early 30s. That gap doesn't sound dramatic written down, but stretch it across an entire generation and it adds up to years of extra rent, extra savings, extra waiting years that a lot of people simply don't get back. And it isn't always the 20-something conversation you'd picture either. Sometimes it's someone in their 40s, with teenagers of their own, sitting down for Sunday lunch and having to ask their own retired parents for £40,000 because the landlord's just put the rent up again and the school catchment area suddenly feels unaffordable. That's an awkward, genuinely hard conversation happening at dining tables from Southampton to Aberdeen. So where does this money actually come from? There's a common myth that the parents funding all this are minor aristocrats sitting on offshore accounts and country piles. A few might be, most aren't. Most are ordinary people who bought an ordinary house in the 80s or 90s for £40,000 or £50,000. A house that's since become worth several times that on paper. They're asset rich. They're very often cash poor. When a child asks for tens of thousands of pounds, parents are broadly choosing between two things. Some drain actual cash savings, the ISA meant for a retirement trip, the rainy day fund meant for a new roof or a dying car. But for a growing number of families, the cash simply isn't sitting in any account. It's locked inside the bricks of the family home instead. That's quietly fueled a boom in what the industry calls giving while living, equity release and lifetime mortgages. Once seen as a fairly niche product for struggling pensioners, are now increasingly used as a mainstream way to pass wealth down a generation early. The share of equity release applications used specifically to gift money to children or grandchildren rose from 13% to 22% in about a year. Parents are, in a very real sense, remortgaging their own retirement to buy their children a slightly earlier start. It sounds lovely on the surface, doesn't it? Giving while living, watching your children build a life, rather than waiting until you're gone to help. But sit with the practical side of it for a second, because it's genuinely uncomfortable. When someone in their 60s takes out a lifetime mortgage to hand over £40,000, that loan doesn't get paid down monthly. It rolls up, compounding, for as long as they stay in the house. By the time that parent passes away or needs full-time care, the original £40,000 gift can easily have grown into an £80,000 or £90,000 debt sitting against the estate. And residential care in this country isn't cheap. A typical care home place can run past £45,000 a year, more again if nursing care is needed. Give away your savings or strip the equity out of your house now, and there's a real question hanging over what happens if you need that same money for your own care in 10 or 15 years. The state won't automatically step in either. Deliberately running down your assets before you need care is something local authorities are particularly alert to, and it can catch up with a family later. None of this comes from some bottomless well of family wealth. It comes from love and worry, and a genuine structural squeeze that pushes parents into quietly gambling with their own security just to keep their kids afloat. The scale of help on offer isn't remotely even across the country either. Take London specifically. First-time buyers there who get family help put down an average deposit north of £220,000. Buyers without that help average closer to £145,000. That's a gap of nearly £80,000 in one city alone, purely from having or not having a parent who can write a cheque. And that's really the uncomfortable truth sitting underneath all of this. The bank of mum and dad is an engine of inequality. If you grew up somewhere property values never really moved, or your parents rented their whole lives and never built up equity of their own, there's no hidden safety cushion for you to draw on. None at all. Buying a home in this country is no longer really a race decided by who works hardest, who studies the right subjects, or who puts in the longest hours. It's drifted into something closer to an inheritance lottery. Get access to family money, and you can buy in your mid-20s, lock in a smaller mortgage, and start building equity of your own early. Don't have that access, and you can end up stuck renting for an extra decade, paying off somebody else's mortgage instead, while prices keep outpacing whatever you manage to save. Now let's talk about the actual mechanics of the gift itself, because this is where a lot of families hit a wall of paperwork they weren't expecting. You can't just have a parent transfer 50 grand into your account the week before completion and hand it to the estate agent. Lenders are deeply suspicious of large, unexplained sums landing in an account, and they'll always ask one specific question. Is this money a gift or a loan? If it's treated as a loan, even an informal, interest-free one agreed over Sunday lunch with a handshake, a lender will factor the eventual repayments into your affordability calculation, which means, ironically, they'll often lend you less, undoing the entire point of the help in the first place. So most families sign something called a deed of gift instead of a formal declaration that the money is unconditional, that the parent has no claim on the property, and that they never expect it back. Parents sign that because they want their child to get the house. But think about what that signature actually means. It's a parent legally giving up any right to that money permanently. Here's a scenario worth sitting with. If a child buys a home with a partner using gifted money, and that relationship later falls apart and there's no formal declaration of trust in place, that £50,000 gift from a parent's savings can end up being split straight down the middle in a separation. Walking out the door with an ex-partner who never contributed a single penny toward it. Then there's the tax side. There's a common belief that you can gift your children whatever you like, completely tax-free, as long as you're reasonably healthy. That's only half true. The actual tax-free annual gifting allowance has sat frozen at £3,000 for decades now, a figure that, if it had simply tracked inflation, would be several times higher today. Anything above that falls under what's called a potentially exempt transfer. If the person making the gift dies within 7 years of giving it, that money can be included in their estate and taxed at up to 40%. It's a genuine, ticking clock hanging over parents who are trying to help while they're still around to see it help. So where does all this actually leave us? The Bank of Mum and Dad isn't a temporary patch on a broken system anymore. At this point, it is more or less the system's quiet infrastructure that is holding up a large share of the UK property market. If every parent in the country somehow stopped tomorrow and refused to gift another pound, first-time buyer numbers wouldn't just dip, they'd collapse. But it's worth being honest about what that actually means for the story this country likes to tell about itself. Britain has always liked the idea of the self-made person who works hard, shows up, applies themselves, and eventually owns a piece of the place they live in. The scale of the Bank of Mum and Dad quietly undercuts that story completely. It doesn't matter how many promotions you get or how much overtime you put in. If your parents didn't happen to buy a house 30 or 40 years ago, you're starting several years behind everyone else through absolutely no fault of your own. And it puts real weight on families either way. Parents who can't help often carry a genuine, private guilt about it. Adult children asking for tens of thousands of pounds at an age when they expected to be fully independent often feel a real sense of shame about needing to ask at all. We're not just passing money down a generation anymore. We're passing down anxiety too. Borrowing security from our parents' retirement to patch over a housing market that stopped working properly for the generation coming up behind them. Next time you walk past a row of ordinary terraced houses, it's worth remembering there's often a far less ordinary story sitting behind the front door. £11 billion, one gifted deposit at a time, holding a lot of those ladders steady. If any of this hits close to home, whether you've had that conversation with your own parents or you're the one having it with your kids, tell me about it in the comments. If this helped make sense of what's actually going on underneath the property market, hit like and subscribe so you don't miss the rest of this series. See you in the next video.